One.
Welcome to Pocket Watchers. I'm your host, Treetop Chris. On this show, we talk about nurturing your wealth and cultivating your future through financial education. Let's talk finance, people. Peace, family. Your boy, Treetop Chris, checking in for another episode of Pocket Watchers. Thank everyone for joining today on TikTok as well as the radio. We on WOLBbaltimore.com as well as the radio station. Again, thank you everybody for joining. We got a show for y'all today, and today we're going to talk about, let me think. We're talking about how much money it takes for you to afford a good home or a good strategy that you can use before jumping out there. And for the people that's already out there to kind of take a step back and really think about like, hey, can I really afford this house that I'm living in? So this goes for homeowners and potential homeowners. Again, thank you everybody for joining. And the people from the past weeks, I know we talked about a lot of different strategies, a lot of different finance strategies that we use as well as credit utilization and plocs and helocs. A lot of y'all really reached out to me about those plocs and helocs. That was crazy. Take these headphones off, making me hot. But anyway, we talked about the plocs and helocs, the home equity lines of credit, the personal lines of credit. That's all well and good, but if you don't have the home to use the heloc, then it's pretty much useless. For the plocs, is actually good for you. You can get that without a home. I actually just posted a video on my Instagram page that explains helocs and plocs in enough detail for you to go out and get the information for yourself, in which case, if that's not good enough, you can always reach out to me, and I would love to help you. Part of what I do is I share a lot of information for free. So if you ever go to the link in my bio, you can schedule a 30-minute talk with me, or go to my website at www.treetopfg.com. You can schedule a 30-minute talk with me for free, and I will advise you as if you are my client for the free. So y'all definitely take advantage of that. People do it all the time. You can only do it one time, though. Don't keep calling me. Take advantage of the fact that you get the free advice. I will give you a strategic plan based on your finances or wherever you are, be it good or bad. You can be living in a one bedroom. You could be living on a corner. You could be making $250,000 a year. You could be making $250,000 or $1 million a year. It does not matter where you are. We have the resources and the knowledge and know-how to help you where you are. So back to today's show. How much house can you afford? You can always look it up online, but it's always better to talk to somebody and have an idea of how to actually play it out, right? So today we're going to try and talk about that, right? We got some examples on some prices for some homes. This might not hit where you are as far as your price range. It might be in your price range, but the strategy that I'm using, you can use for any house price-wise. But today we're going to use a $500,000 home. How much money does it require for you to afford a $500,000 home? So a lot of factors go into play when we talk about how much you can afford. And we're talking about in Maryland. You always have to look at how much money you make before taxes and after taxes. For a lot of people, those words can be skewed sometime and not make a lot of sense. So some vocab words that I want y'all to understand is gross income and net income, right? So what's net? What's gross? A lot of people understand what net and what gross is, but if for the people that are just listening in and trying to understand these concepts, gross is going to be the amount of money you make before taxes, right? Net is going to be the amount of money that you make after taxes. Right. So what do you think is more important? How much money you think you make or how much money you actually make? How much money you actually make is going to be your net income, folks, your net income. So when you get that check and they hit you over the head with FICA and all of those other things that you may have, my man, putting the AC on in here because I'm cooking right now. I'm not too hot. I just came from vacation again. So I could cook an egg on my head in Punta Cana. It was really nice. But anyway, net and gross income. I always want people to focus on net Always focus on your net income. Whenever someone says, hey, I'm going to make a salary of 50,000, 30,000, 100,000, that salary is cool. But what is my net money each month? How much money do I make after all of the FICAs and the taxes and the Social Security that I probably won't get? Because by the time we get to the point where we retire, some of us, it's not going to be a Social Security. But that's a conversation for another time. I just want y'all to understand. Put your money away, folks. You know, I always talk about saving. We're going to talk about that at the end. But the bank strategy, when it comes to being able to afford a home, they talk from a standpoint of gross because they want you to default. Their main source of income is interest. That's how the bank makes money, y'all. They can make money infinitely. And the way that they do it, fractional reserve lending, we talked about that in an earlier episode when I first started doing this show. If you want to go back on my page, you can look at that. The bank has the ability to create funds infinitely and without going into debt. But they can use the funds that they created, the monopoly money that they made, to give it to you as a loan. So basically, they have no money in their hands. You want to buy a house. They place a price on it, and then you pay them back the money that they loaned you, that they made from scratch. And you pay them back plus interest. Now, on the recent video that I created about plocs versus helocs, there's also a video that I made called the mortgage note or death note, where I explain how you calculate the total interest on a mortgage. We talked about that in the previous episode. If you want to go back and check that out, please do. But today, again, the bank uses your gross income to determine how much money you can afford on a home. Now, remember, I asked you a question specifically before we got started. What do you think is more important? How much money you think you make or how much money you actually make? How much money you think you make is gross. How much money you actually make is net. Now, the bank wants us to use what we think we make. So out of the gate, they're smoking us. They smoking a U-pack. That's what they smoking. Whatever you are, it's their opportunity to make some money off of you. But we not going to do that because you're listening to Treetop Chris and we're going to be playing with net. So I'm going to give you what they give us to calculate first, and then I'm going to give you what my strategy is and what I tell my clients. They use something called the 28-36 rule. Y'all ever heard of that? The 28-36 rule? What does that mean? That means that your mortgage cost, right, should never exceed more than 28% of your gross income. 28% of your gross income. And your total debt payments should not exceed 36% gross income. How does that look in a real life example? Let's break it down because you know I love to break it down, right? So we're going to take a $500,000 home. And that $500,000 home, we're going to put down 10%. What's 10% on 500,000, y'all? That's 50 grand. How much are you left with? 450,000. If you're listening to my voice, I want y'all to understand one thing about this show. Now I know I keep stopping, but y'all better bring a pen and paper, or you know, if you can retain this information, that's even better. If you got your phone, pull out your note. If you hear my voice, because I need y'all to really take this and listen to it again. Again, I post all this stuff on Facebook. Well, not Facebook, Instagram, TikTok, and also YouTube every week. So if you want to catch it after that, there'll also be some snippets on TikTok and Instagram for the people who have short attention spans and want to get the information really quick and then ask me a bunch of questions. You can do that. But again, $500,000 home, 10% down, $50,000. That leaves you with a mortgage of $450,000. Okay. Now, say if you have a interest rate of 7%, some people got some better interest rates than that. Some people are holding on to interest rates under 5% for their dear life. And I say this, do not let it go, because it probably won't get down to that again for a long time. But at a 7% interest rate, you're probably going to be spending $3,000 a month on a $450,000 mortgage. So $3,000 a month, y'all, right? Now, that's not including HOA fees or taxes or anything like that, because we have something called PMI that comes into play if you don't put 20% down. So you still got to pay the PMI and all that stuff on top of taxes. So just to play kind of fair, we're going to add an extra $300 to that monthly housing costs. So we're looking at $3,300. That's how much you're going to pay on a $450,000 mortgage. Okay. Now, let's apply the rules. 28%, 36% rule, 28-36. Remember, 28-36 rule. Your monthly housing should not exceed 28% of your gross monthly income. That's what the bank says. So how do we calculate the 28% that we can't afford according to the bank? We take the $3,300 that we normally would pay on that $450,000 mortgage, and we times that by 0.28. We turn in the percentage into a decimal. 3,300 times 0.28. We come up with about $11,785. Right? So that says that you need to make gross $11,785 a month in order to afford a $500,000 home with a $450,000 mortgage. Did y'all catch that? In order to make enough money to afford that home gross in a year, you need to make $142,000 to afford a $500,000 home according to the bank. Right? Now, your gross income, again, on a year, your total debt payments in a month, $11,785 times 0.36. Remember, now we're talking about how much debt you can afford in a month. So that's your mortgage, your car payment, any other debts that you have that you're making a payment on. They can't exceed 36% of your gross monthly income. So if you made $11,785 a month, you can afford $4,260 in debt payments a month. In debt payments. Okay? Now, that sounds cool. If you make $11,785 in a month, $4,260 doesn't sound like a lot. But remember, that's gross. That's not really net. Remember, we're talking about gross and net. We talked about it in the beginning. Gross is the imaginary number. Net is what we actually take home. That's our take home pay. So the bank wants you to focus on what you make, not what you take home. So at the end of the day, why would you count the money that you're also paying in taxes towards your monthly bills? That doesn't make any sense. If they taking money out of my check, why would I include the money they taking out of my check as money I have to pay my bills with? How many of y'all getting hit with taxes every check? How is it possible? Can you take the taxes that they took out of your check and pay your mortgage with it? I don't know anybody could do that. I can't do it, and I'm a financial advisor. Once y'all figure it out, y'all hit me up. Hit me up. Shoot me a text at 410-541-1064. If you figure out how to use the taxes that you got taken out of your check to pay your mortgage with in the same month. If y'all figure that out, let me know, because we're going to make some money together. I'm going to spread the word like wildfire, because I don't think it's possible. I don't think it's possible. But anyway, that's how the bank does it. Okay? They use that gross, that imaginary number. Now, how do I calculate how much you can actually afford in a month? I use 25% of your net income. It doesn't, not 28 and 36, 25% of your net income. That should be what covers your housing costs. Remember the calculation, right? You take how much you make after taxes, because now we're talking about net, and you times that by 0.25. We talked about the $500,000 example prior to this, right? But now we're using a little something different. We're using my strategy. Now, in the same example, before you needed $142,000 gross to be able to afford that $450,000 home. It's a little bit different on my strategy. You need a little bit more money than that, y'all. You need a little bit more. How does it look? Instead of making $11,785 gross a month, you need to make $13,200 a month net. That's after taxes to afford a $500,000 home and be good and be straight. I'm talking about it's not going to hurt you at all. I need y'all to make $13,200 after taxes. That's $158,000 after taxes a year. That's a lot more money than you thought. Not $142,000 gross. And then they take taxes out. $158,000 a year after taxes. How did I get to that number? Because I used $3,300, which is 7% on a $450,000 mortgage. 3,300 times 0.25, that gave me 13,200 or 158,000 net a year. So what is 158,000 net a year in Maryland? This is, if you want to look up your state, you just go, you can use Asset Monitor. It's a couple different sites that you can look at to see what your net would be versus your gross salary, or basically how much would you make after taxes. $500,000 home, you need $13,200 after taxes a month. So you need to reverse engineer this wherever you are, if you're not in Maryland, to figure out how much gross salary you need to make $158,000 after taxes. In Maryland, in order to make that, you need to make $211,000 gross. The bank said you only need to make $142,000 gross. That's a big difference, y'all. $211,000 or $142,000. Who you think is going to be more comfortable in this scenario? I think the person that makes more money. But that person that makes more money understands from a net perspective, not a gross perspective. This is something I learned from a person that is very controversial and in direct opposition to a lot of what I teach. His name is Dave Ramsey. If y'all want to look him up, he hates debt. But the one thing about Dave Ramsey, he used debt to reach to create his empire, and then paid everything off. And now he only buys things cash, and he tells people never use debt. So he's like an oxymoron, or ironic, or whatever you want to call it. But again, your monthly housing and your housing expenses should not exceed 25% of your net income. Y'all write that down. You do your calculations. If you have a home already and your housing, I'm talking about the cost of your mortgage, your HOA fees, your taxes, insurance. If it exceeds 25% of your income, you need to make some more money. Flat out. Nothing else to it. Not even conversation. If you're looking to get a house and you talking about a house that costs $300,000 and you don't have the 25% net income monthly to afford that mortgage plus everything, and why I ain't even say cable, because you're going to throw that in there too. Your housing expenses, 25%. Do that calculation, y'all. Take your net amount in a month times it by 0.25. That's what you can afford. Nothing more. Nothing more. Don't just listen to me. Play with the numbers on your phone. Play with the numbers on paper, and look at the difference between using your gross and your net. I bet you that gross is going to say you can afford way more than it's actually safe for you to do. And because I care about y'all, I'm out here spreading the word so that we can make better decisions as a family. Because I say, hey, family, peace, family, love. That's all I talk about. But anyway, now, how do you take that 25% rule and apply it overall? I use something also called the 75, 15, and 10 rule. Now, we look at $1. 75 cents of every dollar you can use for anything that you want to buy. Every dollar that you make, 75% you use that to spend. That dollar, and that dollar's after taxes. We talking about net. We're not talking about gross, y'all. Remember, net income, not gross. Anybody talk about your salary? Take that money. How much I make after taxes? Some of y'all already smart. Some of y'all already hip. You already know that's how you got to do it. How much money I make after taxes? That's what I'm going to the club with. That's what I'm going on vacation with. That's what I'm buying my car with. That's what I'm paying my bills with. Net income. Okay. So 75 cents of every dollar you use for spending. That's going to include that mortgage. That's going to include cable, Hulu. That's going to include Every type of subscription you have, your entire living life, expenses in a month, every dollar that you get, you have 75% of that dollar to spend on those things. Now, 15 cents of that dollar, you need to invest. It could be a 401k. It could be an IRA. It could be stock market. It could be crypto. It could be anything you want it to be. But 15 cents of that dollar, you need to invest. It don't matter how old you are. You talking about, I'm too old to invest or something like that. It doesn't matter. If you on your way out, you're going to have to pay for that funeral. Don't be disrespectful and leave a bill with your family. Straight up. We talked about that not years. We talked about that not too long ago, probably in the shows prior to the new year. So we're talking 75% of every dollar for spend, 15% of every dollar for investment, and we're going to use 10% of every dollar to save. Now, that housing cost is going to go into your 75%. Remember? 15% to investments, 10% to savings. I don't care if you make $10 an hour. You split them dollars up just how I'm telling you, and you're going to be straight. You're going to be good. Even if you start now and never change up, you'll be straight from here. Because by the time you look back 10 years from now, you'll be like, man, I was listening to this radio, man. It was this bald head dude I ain't never seen before. He told me about 75%, 15 and 10 and how I use net and gross and all this other stuff, man. If I never heard that, man, my life would be totally different. But that's real. It's real. It changed my life. That's how I move. I'm not going to tell you something I'm not doing. I'm not trying to sell you on anything. Remember, at the beginning of the show, I said you can go to the link in my bio. You can go on my website, and we can have a conversation for totally free. And I would advise you on how to change your life financially in 30 minutes or less. If it goes over, please respect my time, because a lot of y'all be trying to talk to me too long. But yes, I do charge my time past that point. But for the free, 30 minutes. But anyway, what y'all think about that? Y'all think is that that's something that you could kind of stick to, using net over gross, using 75% of your net income every month for living expenses, anything that you want to buy, housing expenses, keeping 15% for investments, keeping 10% for savings, because an investment is still a way to grow money. It's not necessarily savings, because when you put something in an investment, depending on the investment that you use, it could be lost. That's why I separate the investments from the savings, because the savings, if you're one of my clients, we only talk about high yield savings accounts. Here's another hit. If your savings account is not 4% or more APY, y'all ever seen that little word APY? You know, annual percentage yield. If you're not giving me more than 4% on my money, I can't sit it with you. That's like throwing it in the trash and coming back later and somebody threw something wet in there and now it's not worth anything. 4% or better APY where my money sits, or it's disrespectful. Or it's disrespectful. But remember, that 15% is for investments. It's up in the air. It might go up. It might go down. Don't ever be afraid that the stock market is crashing. Your 401k is going down, because they set this up to shake these scared hands like we playing poker. Let me say that again. If you ever play poker, they're going to try to put you in a position where you get afraid and you fold early. So they make the stock market crash on purpose. People pull out, they lose money. It's the people who steady their hand, keep their face straight when that investment happens, and they keep on going. You understand? So don't worry about the stock market going up and down. Just make sure that you're investing in companies that are constantly making money over a 10-year period. Over a 10-year period, because the market goes in cycles, up and down, up and down, up and down. They say, where are you? Peace, family. I'm talking to you from Baltimore. We're in Baltimore City. Baltimore County, I think. There's a county? I think it's a county. Yeah, Baltimore County. Maryland. But again, these strategies can be used anywhere in the United States. And, you know, if y'all hear my voice and you have an outlet or an avenue for me to come and speak in your city, please reach out to me via my website or shoot me an email. cbrown@treetopfg.com. If you want to get in touch with me, I'll come speak to you for free. Come speak to you. As long as you got a good group of people, we do something I'm setting up for the summer called the Dollar Credit Education Program. So basically, I come And everybody come in, you learn all the basics of credit and how you can leverage credit for $1 in 1 hour. What y'all think about that? Cool beans? I hope that sounds cool, because I mean, it's a lot more money these people charging you for this information. You can go around a bunch of different places and try to pull it all together, or you could just have me come out and we'll speak to everybody. We'll knock it out and put everybody on a good even keel. And then also, if you shoot me a DM, I have the free credit cheat sheet that I give to people who don't even work with me, who want to build credit or don't understand credit. I got 5 free pages for you that you can get from me, and I'll just shoot it to you in a DM. It's going to give you all the little insights on how to structure your credit profile. It's going to give you some free credit trade lines that you can use to better yourself and others. And I do that also for free as well. But again, today we talked about how much home can you afford. We're going to post some snippets of this on TikTok here and there. But I think it was a good show. If you missed it, that's unfortunate. But we got 2 minutes left, so let's get back to thanking everybody for joining us. Again, I'm Treetop Chris. If you haven't heard my voice, I'm a certified financial planner. I also call myself the money agent. I'm an agent for your funds. And when you have someone like me in your corner, I can help you find all the necessary people to help you keep your money, grow your money, and use your money as you need it. This is what I do for fun. This is what I do for work. This is what I do as a gift from God. So I'm not just doing it to make money. I'm doing it to help people. Say, are you playing? What is that? People ask me if I'm playing video games when they come out. Anyway, it doesn't matter. Your boy Treetop Chris checking in. Peace and love. You were just listening to Pocket Watchers, where we talk about nurturing wealth, cultivating the future through financial education. For more info, visit us at treetopfg.com or follow me on IG or TikTok at treetopchris_. Or you can just give us a call at 1-866-334.